Hello guys and welcome to another Tech Fusion episode. I'm your host Alex, same as always, and today would like to welcome you to another episode where we address some of the things that you should definitely keep into consideration when dealing with this crazy crypto market and of course with the low prices of all the cryptos out there. But before we can continue on in today's video, I would definitely like to mention today's sponsor, which is once again us over here at Tech Fusion. We are giving away $250 in Ethereum, so if you want to be a part of this giveaway, we definitely encourage you to click here, the link. It's a video about 2 or 3 minutes long. It explains how exactly you can be a part of our giveaway and definitely how exactly you can take part and be a part of our community. So we definitely encourage you to do that before we move on with today's video. So I shouldn't exactly call it a crypto market crash. It is not per se a crash. I'm not making it fair justice here by calling it so. It is more or less a deflationary status of the whole market environment when it comes to regards to crypto. But you shouldn't fret, regardless if you're a small miner or a big miner out there, there are some different things that we have to touch upon before you can make a decision in this crypto market environment that we are experiencing today. First of all, you have to keep in mind that you are owning rigs. So it doesn't really matter if you're owning 1 rig, 2 rigs, 3 rigs, I don't know, regardless of the number of rigs or units you're having in a rig, so to say. So regardless of the number of GPUs that you are running, as long as you are running them efficiently and as long as you are making money with your rig, it doesn't really matter if you are making pennies per day or even dollars per day or just a few cents a day. As long as you're covering your bills, so I'm meaning here the electricity bills, and you are getting some sort of profit out of doing the active mining, so to say, you should definitely stick around and try to get more coin as much as you can, because this is definitely going to be something that you are going to wish you have done when the crypto market turns around. A quick parallel between a miner and, in a classic sense, a traditional trader is that the traditional trader doesn't really get involved with any of the equipment or any of the work of the proof of work concept behind of all these cryptocurrencies. He just takes his money, puts it behind a cryptocurrency that he believes in, waits for some time to pass, and of course the value of that cryptocurrency to jump up in price. And once he is happy with the price that the cryptocurrency has reached, he can sell it off and quickly make a profit. The obvious advantage that you have as a crypto miner is that you are actually having your money tied into some physical object. So I mean here the hardware side of things. So you have your money put into some sort of GPUs or ASIC miners that you can definitely, if push comes to shove or the worst scenario comes around, you can definitely stop mining altogether, turn around and sell your equipment off to the next person, and might even be able to make a profit because the GPU markets are still crazy and the prices are still overly inflated and there still is a general scarcity of GPUs out there. But this is absolutely the worst scenario where you stop completely, you want out, you don't believe in crypto markets anymore, you don't believe in crypto, you think that, oh, it's going to go to hell. So then of course you stop and sell it off, and of course you're going to recoup a part of your investment or maybe the whole investment, because as you can see or as you can know, you can sell off your rigs, you can sell off your PSUs, you can sell off your cables, you can sell off your GPUs, of course. So all of the things that you have gotten yourself involved in are actually good assets to have around, because you can just turn around and quite easily sell them and get your money back. This is not something that a traditional trader can do. He is locked into this death battle where he is hoping and waiting for the price to at least come back up to his initial investment before he can consider to actually back out of that position and maybe invest his money into something else. Another set advantage that you have to consider your position, because if you are the type of miner that is actually making a living out of his own equipment, so if you're the type of person that it actually turns around and sells quite quickly all the money, all the crypto that he is making, then definitely this is something that is going to restrict you a little bit, in the sense that you can't have the luxury of waiting around and stacking up the coins and waiting for a better time to actually sell it off and make a profit, because you're actually forced to make a living out of the whole situation. So this is definitely the worst kind of position that you can find yourself into as a miner, because if you're not generating enough income to both cover the electricity cost and your living expenses, then definitely can degenerate quite quickly into a situation where you have to sell off all of your equipment and move into something else. But if you don't find yourself in this situation, I definitely urge you guys to just hold on to your coins, and I will show you briefly what happens with an account, or maybe I should say a mining pool, and with my situation right now when the crypto markets are low, because definitely something that you have to keep in mind is that when the crypto markets are low in value, you are generating more coin in a specific asset than you would in a crypto market which is high, where you would be generating a little bit less. So if you find yourself in a position where you can hold and wait and just stick around for the price to go up for Ethereum or Bitcoin, then definitely stick around and wait for it to do so before you can pull the trigger and sell off some of your coins. Right, so this is my Flexpool account over here. I do have to mention that we are running the same 3 rigs on this platform. So that is the RTX 3090, the RTX 3080, and the 6700 XT, all of them mining 24 hours on this here pool. So this being said, I'll just compare the December 20th value with the January 25th over here. And as you can see, we have been able to mine all that extra little bit more in terms of coin than we were able to do so on December 20th. So let's take a look at the price and see exactly what the prices were doing at the beginning of December up until December 20th. So as you can see, the average duration of the payout was around 13 and a half days here. That's because I have a set threshold for the transaction fee. So I don't want to overpay when I'm taking money out of this account. So that's why you'll see some variations here between the duration of the payout over here compared to the one over here or with the rest of them. Because sometimes the network fees are very high with Ethereum. So if you don't want to pay too much for that, it's definitely a good idea to set a fixed value that you don't want to overspend with the transaction fees. So 14 days compared to the December 20th, that means we have to look at the price, what the price was doing in Ethereum for the 6th of December up until 20th of December. So the 6th of December, if we take a look here, that is right about here. So as you can see, the price was starting off from 4,155 all the way up to December 20th, where we actually see a downturn of Ethereum where it stopped at around $3,852. So overall, it was going down, but it reached $3,850 by December 20th when we had the payout. And this gave us a yield of Ethereum of 0.0486. Roughly translated was $117 at that moment in time with a set fee of $3.51. So let's compare this with the next value which comes close to this, which is January 25. I'm not comparing it with January 9th because it took around 19 days to generate more Ethereum. So this is actually not fair as a comparison. So the next value that I can compare it to is this one over here with 15 and a half days compared to the 13 and a half days. So it's more or less the same as December 20th. And I will show you anyway, because the price continued to drop up until November 25th, what happened exactly with our Ethereum yields. So the Ethereum yield of January 25th, as you can see, it took 15 and a half days for this to happen. Let's just say an even 15 days. So we just have to look at the price between January 10th and January 25th. So looking at the price of January 10, let's see here. All right, this is where we started off. We started off at $3,177 all the way up to January 25th, which is right about here, jumped down to $2,425. So quite a significant drop, I would say. January 10th, 3,177, so close to 3,200. Close to the 2,300 right now, which is on January 25th. So it is more or less the same yield as you can see here between December 30th and January 25th, although there is a marginal increase in value here for the yield compared to December 20th. I know you might say this is because of the duration, but it is actually not because of the duration. It is because you are actually yielding more when the prices are low, because there are less people involved in mining. So that reward actually gets distributed to, well, less miners overall than in high peak seasons where the values are set to be higher. So just comparing the December 20th yield here is 0.0486 compared to the January 25th one here, which is 0.0496. It's not a big difference. Of course, you might say this is attributed to the fact that the duration was a little bit longer on this one, and that is partially correct, but this is also something that you can see happening quite a lot when cryptocurrencies are down, because overall there are less miners involved in mining the asset, and of course the reward in the system gets attributed to less people, so that's why you get a higher yield overall in Ethereum. But this difference right here, of course, for me is not something substantial, because I'm only having 3 GPUs involved. So that is the RTX 3090, the RTX 3080, and the 6700 XT. But if you would be running 20, 30, 40, 50 GPUs, I don't know, a lot of GPUs, then you would definitely be seeing a lot of a bigger difference here between the yields when the prices vary in certain cryptocurrencies. Thank you once again, guys, for choosing to watch this video. This was Alex from Tech Fusion. Don't forget that you can leave all your thoughts and comments down in the box below. We'll go over each and every one of your comments. So if you do have your questions, please leave them down in the box below, because we are going to answer your questions. And of course, maybe you can consider subscribing and liking our videos. And why not, we hope to see you over our Discord server as well. So don't forget, the links are down in the box below. Thank you once again, guys, and see you in the next one.